Hello traders, Gary Wagner here. Approximately 1:45 in Honolulu, 7:45 in New York. It is Friday. Happy Aloha Friday, as we say on the islands, June the 4th, 2021, and this is the daily report for gold and silver, our weekend review, and what a week we have seen. Better put, what a couple of days we have put with the U.S. jobs report today and ADP's report tomorrow, completely contradicting each other to the point where we saw a $37 drawdown in gold yesterday and a $20 gain today. We'll talk about that in detail when we pull up our charts, but it is copper that I continue to get exceedingly excited about. We'll talk about that too, all on today's show, which begins now. Over the last 2 days, traders in the financial markets, and specifically gold and silver, have been on a virtual roller coaster ride, with the ADP report resulting in tremendous bearish market sentiment and selling pressure, taking prices from well above $1,900 to close at $1,873 per ounce. The market actually opened below that price point, and the low of yesterday, which was $1,866, when we saw gold trade to a low of $1,855.60. However, once the jobs report was released, coming in well under expectation, we saw a dramatic recovery and a solid gain on the day of about $20. As we commented on yesterday, we did not have any major chart damage. We had consistently seen gold prices above the 200-day moving average. We are looking at a 50 and 100-day moving average, and we can definitely see that a golden cross occurred on the 24th of May, not that long ago. And so in terms of its technical demeanor, it is still absolutely a bullish market. Secondly, what today's report by the Labor Department underscores is the Federal Reserve is probably not going to be that quick to pull the trigger and stop their quantitative easing program, the accumulation of $120 billion worth of assets each month, although there is talk of tapering the corporate bonds right now, and certainly not going to raise their Fed funds rate, which is currently set between 0.25% anytime this year and most likely next year. This recovery will be a long and stagnated recovery, but it is a recovery, and the economy is showing a rebirth and regrowth, and that is something to be thankful for. In the meantime, the policies that allowed this economic revival, such as fiscal spending to the tune of $4 trillion last year, $1.92 trillion so far this year by President Biden, with a proposed infrastructure that could come in anywhere between $1 and $2 trillion, depending on whether the Democrats push it through or look for bipartisan support. Nonetheless, we did see a key reversal in gold, and it is simply a matter of positioning ourselves from the long side in this metal after being stopped out yesterday. Traders, while this wasn't a black swan event, it certainly took many traders by surprise, including myself, that we would see this kind of volatility over 2 days in 2 reports. This first chart that we're looking at is an area chart based upon the close, and it is a 15-minute incremental chart, so that we can definitely see the action leading up to the release of the ADP report, the subsequent fall that followed, the unsteadiness that came in between the reports, and then the release of the Labor Department's report right here, getting back roughly half of the sell-off that occurred yesterday. What I really want to underscore on today's show is that no major chart damage occurred on a technical basis, and in terms of the fundamentals, I don't believe that they have changed. The Federal Reserve is talking about different scenarios, but I believe that they're committed to keeping interest rates low, and the tapering or quantitative easing is yet another thing, but I don't believe that that's going to occur all that soon. Absolutely not this year. I could very well be wrong, but this is the action we saw over the last 2 trading days. Copper also rebounded to the tune of 1.2%, and copper was the one metal that I found odd that sold off yesterday to the degree that it did, because it's an industrial metal and higher employment would signal a greater regrowth or rebirth in the economy, and therefore should not have been under pressure. That is why I made the recommendation yesterday for those that have the capital available to double up and to add to their long copper positions at this lower price. I did that. Entry price on that was $4.47 per pound. We'll talk about that when we pull up our charts. I still truly believe that copper has tremendous upside pressure. In fact, yesterday I spoke about adding to our positions. In fact, let's take a listen to that clip from yesterday's show before I discuss this particular chart and our upside targets. And as I said, I am extremely bullish long term. Maintain your current long position. Maintain your current stop in copper. I would even consider, if you have the funds available, to add to that position at this particular price point. This daily chart we are looking at are my upside projections. They're based upon Elliott Wave. They're also based upon two accepted models. The first model is to look at a wave 1 and then a fifth wave as being equal in length. The second one is to measure the length of wave 3 and then run a 0.618% Fibonacci extension. I will talk about this chart in detail because what it really shows us is not only the timeline, but the potential for copper to definitely exceed $5 per pound. And my upper end target at this point is approximately $5.50. Hopefully there were those out there that took advantage and did dollar cost average at a lower price. As I said, we entered at $4.47 per pound on the second leg of this position. Maintain your current long position and your current add-on. Stops continue to be at 439.6. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you on Monday for the next daily update and review. Bye-bye.